Hi guys, welcome back to my channel. Kelvin here. So recently this happened. I got a Mapletree Commercial Trust. I got a Mapletree North Asia Commercial Trust. I got a bunch of angry MCT investors. On 31st December, MCT and MNACT has announced that they plan to merge to form Mapletree Pan Asia Commercial Trust. Nice. So in this video, I decided to check out what's this whole merger about. What's the effect of the merger? Why did they want to merge? Why are MCT investors not happy about it? Then finally, I will share with you my thoughts about this whole merger, whether it's a good thing or not. But before I start, I would greatly appreciate it if you can help to tap the like button because it will help out with the channel. In return, I will show you a happy seal. Alright, let's start right now. Okay, let's first talk about what you can expect for this merger. 5 properties from MCT and 13 properties from MNACT will merge to create a more diversified portfolio from 5 different countries. And because of this merger, the top 3 tenants will now be Google, BMW and Seiko. The new REIT will become the 7th largest REIT in Asia. They are big but still smaller than CapitaLand Integrated Commercial Trust and Ascendas REITs. The free float will go up to $6.7 billion and their weightage in different indexes will go up. Like in MSCI Singapore Index, it will go up from 1.6% to 2.4%. Next, the dividend per unit will increase up to 4.78 and net asset value will go up to 1.8 depending on what the investors choose. Besides that, the management fee structure has changed a bit. Previously for MCT, the base fee was a percentage of total assets. So hypothetically, even if the manager is not doing any work, he can still earn a lot because of how big their assets are. Hypothetical only, I'm not saying that the manager is lazy. But now the base fee has changed to a percentage of distributable income. So it's more aligned to investors. Because now, if investors hop big, the manager will also hop big. As for the timeline, there will be an EGM for the voting in April. And if everything sui goes through, by May, everything will be finalized and in June, MNACT will delist and investors will receive their distributions. So everything is good, right? Right? The easiest way to check whether investors like the news or not is to look at the stock price. You can see that around the time the news was announced, MNACT has went up as high as 5% and MCT has dropped by 9%. Some people be like, wow, sold out of 17 million units from $1.91 to $1.87 in a blink. Meanwhile, Tesla and crypto holders be like, first time? So by looking at the share price, you can easily tell that MNACT investors were happy with the news and MCT investors not so happy. Moody also came and downgrade MCT and at the same time upgrade MNACT. The reason for the downgrade was potential weakening of MCT's credit metrics and uncertainty around its financial policy. Meanwhile, the reason for the upgrade was MNACT could benefit from the deal. Fun fact, it's not the first time Moody come and kacau. When Fraser Commercial wanted to merge, they go and downgrade FCT. When Capital Mall wanted to merge, they also go and downgrade Capital Mall. So yeah, Moody always like to come and capo. There's nothing to worry about for the downgrade. Other than that, there were also news that institutional funds have sold $87 million worth of MCT shares after the merger announcement. Okay, let's go through all the reasons why this merger is bad for MCT and good for MNACT. First, MNACT's debt. Check this out, MCT's gearing ratio is at 33.7% and MNACT is at 42.2%. Just in case you're blur and don't know what's gearing ratio is debt over total assets. The higher debt you have, the worse off you are. Basically, that's what happened to HiFlux. Their debt to equity ratio was a godlike 155%. But of course, MCT and MNACT's gearing ratio is not that high lah. If so high, they gone case already. However, if you look at the current gearing limit, it's at 50%. Before the pandemic, it was at 45%. After joining, the new gearing ratio will become 39.2%. So essentially, MNACT benefited here while MCT had to take on additional debts. Quick pause, right now, Mumu has a January promo. They are giving out one free Apple share worth around $170. On top of that, you will also receive 40 SGD cash coupon bundle which you can use to offset your stock purchase. But wait, that's not all. You will also receive 180 days commission-free trading and free access to level 2 US market data. To qualify for the promo, all you need to do is just sign up and deposit 2.7k SGD. But if you are a student, you only need to deposit 1k SGD. So that's nice. This promotion ends on 31st January 10 AM. So if you have not signed up yet, you can sign up using my link down below. With that being said, let's get back to the video. Second downside, MNACT's assets. If you look at MNACT's portfolio, you can see that Festival Walk contributes to 54% of assets under management and 48% of gross revenue came from it. Just in case you are not aware, Festival Walk is in Hong Kong. And what happened to Hong Kong a while ago? Yes, protests. And Festival Walk was affected by it. They go and burn the Christmas tree, vandalize the mall, and Festival Walk be like,
Base is under attack.
the mall had to be closed for 2 months for repairs. After that, they reopened in January 2020. Oh wait, did you say 2020? That's when the pandemic broke out all over the world and festival work was affected. In April 2020, retail sales and footfall were at its lowest. But right now, situations had definitely improved. However, not everything is sunshine and rainbows. If you look at Festival Walk's average rental reversion, there's a godlike negative 30% rental reversion. Just in case you don't know what's rental reversion, basically it's just change in rents. So if it goes up, means MNACT will get to collect more rents and investors will get to whop big. But if it goes down, means MNACT will collect lesser rents. And in Festival Walk's case, the rental has dropped by 30%, which is bad, considering that Festival Walk contributes to a huge portion of the revenue. But wait, that's not all. MNACT's other property, Gateway Plaza, also had a rental reversion of negative 24%. And Gateway Plaza contributes to 18% of gross revenue. So that's bad too. Maybe you'll be like, but Pinnacle Gangnam in Seoul had 58% rental reversion. That's good, right? Yep, that's good. But Pinnacle Gangnam only contributes to 3% of revenue. So it ain't much, but it's honest work. On top of that, one of Gateway Plaza's major tenants might not be planning to extend beyond December 2023. This means that Gateway Plaza's revenue might continue to drop for a while. If you check the new REIT, both Festival Walk and Gateway Plaza will be taking up around 34% of the entire AUM. So this will affect the overall performance of the entire REIT. Third downside, Forex risk. If you look at MCT's portfolio, all of them are in Singapore. They'll be like, this is home, truly. Meanwhile, MNACT's portfolio is in Hong Kong, China, Japan, South Korea. When you have overseas properties, there will be Forex risk. If we look at the chart, we can see that over the past few years, only China Yuan has strengthened against SGD. All the rest have dropped, like Japan Yen dropped by 6%, Hong Kong dollars dropped by 10%, and worst of all, Korean Won dropped by 31%. If you look at the AUM breakdown, 51% of the assets belong to Singapore, and the remaining 49% are overseas assets, which will be exposed to Forex risk. So, because of all these downsides, many people felt that MNACT is underperforming and the merger is to bail out MNACT. That's actually quite obvious lah. But besides this, there are a few more reasons why the merger makes sense. All along, MCT's main focus is only in Singapore. If you check MCT, the last time they acquired a property was all the way back in 2020, when they acquired Mapletree Business City. Compare that to Ascendas, where they have been busy buying this, buying that, like they are playing Monopoly in real life. They'd be like, all your bases are belong to us. The reason MCT hasn't been acquiring new assets for so long is because almost all the assets are already bought up by other REITs. Like, you want Bedok Mall Oh, sorry lo, CapitaLand owns it. Or you want Changi Business Park Oh, cannot lo, Ascendas already went and bought them out. All MCT has is just 5 properties in Singapore. And they are super proud of their properties. Like, Vivo City is Singapore's largest mall. Mapletree Business City is one of the largest integrated development. Mapletree Anson is one of the first buildings to be awarded a Green Mark Platinum cert. Nice. But meanwhile, they haven't been able to acquire any new assets for the past 2 years. So with this new merger, MCT will be able to access more markets in Asia. On top of that, by becoming the 7th largest REIT in Asia, they will have better bargaining power. And by combining their funds, they will have more money to buy bigger assets and upgrading existing ones. Bigger AUM also means that it will be much easier for the REIT to divest the assets they are underperforming while having minimal impact to the REIT's performance. Okay, here are my thoughts. Whether this merger is good or not depends on why you bought the REIT in the first place. If you are an MNACT investor, oh, this merger is 恭喜发财, what big merger for you. Ever since the Hong Kong protest, MNACT be like, I don't feel so good. Stock price has dropped and it has been below 1 price to book value ever since. With this merger, MNACT investors will be getting better assets and going forward, the situation will be better for them. On the other hand, if you have bought MCT because you like the fact that it doesn't have any forex risk, it has good performing assets, then this merger feels like a very bad deal because you're getting all the bad stuff from MNACT. In the short term, I would expect MCT to continue going down because I see that many investors don't like this deal. They'll be paper handing and selling MCT. As for MNACT's investors, don't feel so happy yet The merger is not confirmed yet. They still have to go through a voting process in April, and if this merger gets voted down, MNACT will have a mini crash. However, if this deal goes through, in the short term, I feel it's a bad deal. But if you look at the bigger picture, this deal will actually benefit MCT over the long term. They will get more funds to use and will have access to a bigger market. So hopefully after this merger, they can continue chop clean up their portfolio and acquire more assets. Also, check this out, there were a few REIT mergers in the past few years. Most of the REIT mergers gave positive returns except for OUE Commercial REIT, which gave a negative return. So hopefully this will be the same for this merger. Finally, if the merger goes through, MNACT investors will be given two choices. Do you want to convert to 84% of MPACT at $2 and remaining 16% in cash? Or do you want to convert all 100% of your shares into MPACT? Here's how to choose. If you like the new MPACT REIT, then just take all 100% of it lor. If you don't like it that much, but you still want to stay invested, you can just convert 84% into MPACT and take back the remaining 16% in cash. But there's one more hidden option. If you totally don't like this new REIT at all, then just paper hands and sell everything now and use the money and go buy some other REITs. So whichever you choose totally depends on how much you like MPACT. Anyway, that's all for my thoughts. But what do you think? Do you like this merger? Or will you be like, you shall not pass during the voting? Comment down below and let me know. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.